there for over a decade, so I've seen a lot of these different situations and seen the whole activism space sort of transform over the last 10, 15 years. So getting to the topic, contested M&A transactions, I thought it might be helpful just to start, kind of break down a deal into some of the elements that could be the source of contention. Obviously, there's price, which can upset a shareholder base, or the valuation of the standalone entity maybe is the reason for pushing for an M&A transaction. Once a deal is announced, you can have shareholders question the strategic fit, the strategic rationale, the overall process that the board took, what the structure was to getting to the deal, or also the overall timing of the deal. So I guess with those kind of broader key components in mind, I thought it also might be good for Chris maybe to kind of go through the different flavors or types of contested M&A transactions. And being that you've worn different caps and kind of sat in the chair that I sit in, not literally, figuratively, talk about the types of contested M&A that you see and how you kind of think about them.
Yeah, thanks, Mark. I think of it two buckets, and the second bucket has, I guess, a third bucket inside it. The first one is when acquirers are unhappy, and they rarely get a vote, but as most of you probably know, in some cases they do. If it's a stock deal and issue 20% of your stock, and of course we're reading about Ritchie and IAA, and that's really an acquirer. It started off actually on both sides, and I'm sure we're going to talk about it, but right now it's Luxor as an acquiring shareholder upset with the transaction. And these are rarely voted down from the acquirer side for various reasons we'll get into. I don't want to steal anybody's thunder. The other type is the target, the more common target shareholder opposition, don't like the price they're going to get, in particular with going private transactions, right, where there are potential conflicts of interest. And to me, there are two types of investors on the target side that oppose agreed transactions. One is sort of the short-termist that comes in after the deal was announced and opposes it and walks away with a few extra cents. We call that bumpitrage. Elliot's very good at that in Europe. Icon is pretty good at it as well when he feels like it. And the others are true believers, fundamental investors, long-term investors that everyone has a different model. Everyone values companies differently. They have different time horizons, and you can get certainly like a T. Rowe Price. When I was at ISS, probably was the most vocal against agreed transactions, in particular management buyouts. But also, I think there's something that people don't talk about. I know it's changing with the private capital markets, but there are, if you're a PM and your job is just to invest in publicly traded companies, and I remember this from the big TXU buyout many years ago. When you take a utility the size of TXU out of the market and give the portfolio manager a lot of cash, he or she has to put it somewhere. And he described that to me as an inventory problem. And so, yeah, unless it's a real, you should be, rationally, you should take the offer if it makes sense. But there are other considerations based upon the business model of the shareholder.
Lawrence, from I guess where you sit, what sort of situations of the different types of contested M&A do you find yourself working on more often, or maybe perhaps more interestingly, in the current environment, in current conditions, what type do you think that lends itself to?
Good question. The lawyer answer is it depends. usually in these situations, we're either brought in as a specialist to work with the board of the company trying to get the deal done in the face of opposition, whether it's the acquiring company or the target company. But there are occasions that investors will come to us as well, who either want to see bumpitrage or want to see the deal die, and have the company then move on to another phase. It's actually interesting when a board has said to its shareholders, we've run a process, we think it's a fair process, this is the best value that we can get for you shareholders, period. And then the shareholders say, by the vast majority, no, we don't think this is good value, we're voting it down. Now you have a whole board that's in jeopardy. So a lot of times when boards are concerned that the reaction to the deal was so negative, they have a contractual obligation under their M&A agreement to try to get the deal voted through, but they now want to prepare for the situation where their angry investor base that voted the deal down is now coming after their board seats. So we get hired in that regard too. And what we usually see in these situations is, and it's really, obviously companies, boards, and advisors do not have a crystal ball. They do not know how the market is going to react. But usually the market reaction is affected by the story that is not told about the deal. Usually what happens in these M&A transactions is you have to wait a month to 2 months, sometimes 3 months, for a proxy statement to come out that describes the procedural process and the substantive process the board went to get the best value possible. And maybe a presentation is put out about that to make the case to shareholders to vote for the deal. But usually the deal announcements come with a 3 to 7 slide presentation, a joint conference call that lasts for 15 to 20 minutes, and that's all shareholders are getting. And usually it's that absence of information that makes shareholders say, wow, I should try to get more money out of this deal. I should try to get the deal voted down. I should try to see if an interloper could come in and possibly pay more for it, or take other action. Usually it's human nature when there's silence or an absence of information, you get worried and you get angry. So we see that a lot. Oftentimes, if we can get involved earlier with companies that are concerned about deal opposition, we can help with the advisory teams in getting the story right. In terms of when you're working with an investor, I always say it's more fun. As a person that does mostly defense work, working with investors is a lot more fun because you can just kind of say and do whatever you want. There are securities laws you have to follow. Don't get me wrong, but in these situations, when there's this dearth of information, this gap for like 2 or 3 months before the proxy statement comes out and the detailed presentation comes out, we found that you could have angry investors pelting the company, explaining why the deal is no good, and really building a groundswell in the shareholder base. And then by the time the company comes out and says, well, the deal's actually a good, look at this great process we ran, it's too late.
In terms of telling the story, oftentimes it also seems to be the strategic part of the story, further explaining the rationale of the deal, which the companies obviously have a pretty big opportunity to do that at the announcement of the deal. Clearly a lot of work has gone in before they do the deal announcement and the analyst calls. But I guess in that kind of void of information, it creates an opportunity sometimes, and that might be a decent place to talk about Ricci Brothers and IAA, where you had shareholders shortly after the announcement vocalize their deal concerns and their reasons for opposing on a number of issues, not only valuation, not quite as much on process, but maybe more on strategic fit. And more recently, you've had the companies try to kind of recraft, some would maybe say, the story, point to synergies that weren't discussed at the announcement, but suddenly we found 2x or 3x times the amount of synergies if this deal goes through. So I think everyone might have something to weigh in, or there's a lot to talk about with that deal. So feel free, anyone, to jump in on that.
How about Bruce?
Well, thanks, guys.
You must be on one side of that.
We represent Luxor in the Ritchie campaign, as does
Just
John.
going to say, I was supposed to be sitting beside Bruce. I'm supposed to kick him if he says anything inappropriate. But anyway, go ahead, Bruce. Just assume that I'm kicking you. Yeah.
Probably at every thought that comes out of my mouth. But let me preface these remarks by partly saying, these are mine, not necessarily Luxor's if I talk about Ritchie Brothers. But part of what we do at Okapi Partners is we represent clients in shareholder outreach campaigns. And that means in these kinds of elections, we sometimes work for the company, the targeted company. We sometimes work for the acquirer. We sometimes work for a third party who has an opinion about the deal. And so among this group, I've worked with everybody here on one side or another. And so there are perspectives that you come to appreciate on these transactions. And Ritchie Brothers IAA is among the more fascinating situations in the last 5 years, because there are so many different investors who have opinions, and the opinions are all over the place, and the opinions have evolved in the last month to month and a half, so that we started out with a situation where the deal was announced, and I think this is what Mark was alluding to. There was a strategy and there was a discussion of so-called synergies, and suddenly there was opposition on the IAA side. There was opposition at the Ritchie Brothers side. And so then there was a reconfiguring of what's good and what's purportedly good about the deal. And then in the last few weeks, you've had another investor who's come in who has a great deal for that investor, but not necessarily is it a good deal for other investors at Ritchie Brothers. So there's a lot of dynamic at play here, which means that every day between today and when the shareholder vote occurs, you may hear different news and different opinions that can impact the ultimate outcome. And part of that outcome means going to talk to Mark and his team, going to talk to the team that currently exists at ISS that Chris founded, having advisors to create that strategy along the way, and we'll get a whole bunch of different messaging to get there. There's my thoughts.
Didn't we just get something yesterday where we have the target, Ancora, the target shareholder that was opposing from the target side, is now publicly going after the Luxor, the acquirer shareholder.
Yep.
I don't know if I've ever really seen that.
It's sort of this activist hate on hate.
It's some like Pac-Man defense. Somehow it's a Pac-Man defense. I just wanted to mention a video game.
Yeah.
Mario Brothers. I think that it's fascinating where you have the shareholders, at least initially you had some shareholders in the acquirer, in the target rather, who are suspicious about the deal, saying this is not enough money. And then you have a number of shareholders in the acquirer saying this is too much money and it's not the right fit. So there has to be some truth that there's something wrong with the deal on some level. If you've got the opposition on both sides, usually you have the shareholders at the target saying you're not paying enough for this asset, and then you have the acquirer shareholders voting it through because they're stealing the asset. So it's really a fascinating dynamic.
The share price.
Correct.
So this is a situation where you have investors at the acquirer saying, there's not the same strategic fit that management claims there to be. And that the investors in the acquirer are saying, actually management can focus on building the great business that they have, and that this transaction will ultimately dilute that situation, and that this transaction creates an empire for management but not value for shareholders. And that's not an argument you usually see. That's what makes this interesting. You're right, Lawrence. The arguments are usually around, we're not getting value in the target company.
But doesn't the share price reaction of the acquirer, which was poor,
Yep.
that's a market signal. And that's usually where you get the acquirer shareholder opposition. I remember, speaking to Carl Icahn one time, and he was on a treadmill watching CNBC. You may remember the Mylan King Pharma merger, and he had no knowledge of either company. He just watched the announcement of the deal, and Mylan, the acquirer's share price chart going like this. Yep. And he said, Chris, I hopped off the treadmill and bought a bunch of Mylan. And I'm gonna stop the deal, which he ultimately was able to do. I didn't want to put you on the spot with Richie, but Mark. Yeah, but just in general, do you guys look at share price reaction as kind of an objective vote by the market? And if you do, is it one day? Is it?
Yeah, I think it's definitely a signal that we have to take into account. It's on the acquirer side generally is where that comes into play. Yeah. Although we do look at the deal spread on the target as well. If target's trading above an offer price, especially a cash offer price, that's either saying that there's a better offer potentially that come to the table, or that the company's standalone prospects are so great that to take this offer would be the wrong choice. So yeah, I think we try to look at it over time. We don't have a lot of insight into this piece of it, but there's obviously a lot of merger arbitrage strategies. And you get shareholders trading in and out after a deal, so it sometimes can be difficult to assign a share price change, post-deal announcement share price change, just to the merits of the deal. There's a lot of kind of market mechanics, trading in and out, liquidity issues there. So we try to weigh all that and factor it. I think with Ritchie Brothers and IAA, the other interesting part is after the initial opposition, they restruck the deal terms. And generally speaking, that's kind of the end game. If a price is bumped or changed or something, normally that satisfies whoever has been upset. But in this case, there's been so many constituencies, so many individual shareholders upset across the board, like Bruce said, that not only did it made some go away, but it brought out new ones. So where you had more traditional non-activist holders who generally don't say anything about any deals, suddenly they've come out of the woodwork now. Your Janice Henderson types who published a public letter as a Ritchie Brothers shareholder on the buyer side, who now is even more against the deal after the revised terms. So it's an interesting one in that regard. I don't know how much you want to talk about Ritchie on your side, but
I won't talk too much about Ritchie, just because harder for me as the lawyer, as Luxor's lawyer, to really talk about it. But what I will say is it is a unique situation in Canada. Number one, it's very unusual for there to be a lot of M&A activism. For years, I heard about it as a phenomenon in the U.S., and it was something that, even though Canada is extremely shareholder activism friendly, this form of activism wasn't something we were seeing that much of. However, it's changing a lot, and I think Ritchie Brothers is sort of a big catalyst for that in Canada. And now, literally, we had a call a week or so ago just talking about it. Every day there are deals getting announced, and every day now shareholders are expressing extreme displeasure with transactions. And I think a large part of that is opportunistic buyers and trying to get sort of bargain basement prices that some boards are are actually favoring. And one of them that was just announced that was just publicly contested today was a $1 billion deal that Thoma Bravo made to acquire a company called Magnetic Forensics. But what happened there is the insiders were given the option to roll their interest, which they're doing, into the sort of ongoing company, whereas the public shareholders are being asked to basically get cashed out at a price that a lot of the shareholders think is insufficient. And there are mechanisms in Canada to deal with that. And not only is the vote going to be those of just those issued and outstanding, and just those voting rather than issued and outstanding, but there's also a requirement under our laws to allow a majority of the minority vote. So not only does it have to pass by 2/3, you also need to have a vote where the minority gets to say yea or nay on just a majority basis. And those tools are available, and our US clients are always thrilled to know that there is a real mechanism to stop these deals when they don't seem to work. So I'm thinking there's going to be a lot more. I think Ritchie Brothers has kind of opened the door in Canada for this type of activism to grow.
We're very glad in the U.S. to be exporting our activism brands into Canada.
Well, like we said, we give you comedians, and
Yes,
we'll take the activism.
We'll take your comedians. We can have Chris debate with you where the better hockey players are. Chris's roots are in the New England area. That could happen afterwards. Yeah. What's interesting about the situation where management rolls is if I'm just putting my shareholder cap on, I'm super focused on the proxy statement and how and when and how early management was completely walled off from discussions and deliberations about the deal. You can make the argument the moment that a proposal comes in to management that involves a roll of their equity, that a committee should be formed and they should be walled off. That's what's done in the U.S. I assume there's similar mechanisms in Canada.
Required by law.
Yeah. And for shareholders to be able to pore over that information, well, maybe they shouldn't have to wait, for the proxy statement or the circular to come out to see that information. Maybe it should come out first. And, for what it's worth, there are some terrific communications firms out there that can get in the trenches with you in real time that have the ability to look around corners. And a lot of companies are scrambling at the last minute. They're not thinking, how do these words, how will they look to shareholders? How will they look to the voters? They're more focused on just getting the news out there, and is there going to be a pop, is there not? How's this going to look to voters a month from now? So again, we recommend, particularly in that scenario, there's got to be a really high and impregnable wall between management and the board.
Another question for you, Bruce, and it kind of touches on Ritchie Brothers. It doesn't have to be specifically, but when you're representing an investor who's against a deal, there's various ways that they can express that opposition. You can just file a press release. You can put out an investor presentation varying from 5 to 10 slides, which is what we like to see at Glass Lewis, to 100 slides, which gets a little bit more cumbersome. There's any way, at what point do you find clients want to, or would you advise them to actually go through a solicitation of votes against a merger, which I think Luxor has at least filed preliminary?
I'll give the Lawrence lawyer answer is it depends.
You're a lawyer.
I am, by training. Still, I guess, have my license. But it really depends. I mean, an assessment of the situation, the composition of the shareholders really will be impactful before we were to advise a client as to what action to take. And so in a situation where there are an impactful amount of retail shareholders, we may be more likely to want to go to the shareholders and have them vote than in a situation where it's a few institutions, where you can know that you can communicate somewhat directly without having to reach out and get their votes, that those investors are going to take action. Those investors are willing to hear the thought and opinion of another large investor, in contrast to a situation where you have a really disparate shareholder base. You have to know that those investors, many of whom are just apathetic to a situation and not likely to take any action unless somebody reaches out to them, need that help in overcoming their apathy and in getting an answer that is more logically decided than just receiving material in the mail or allowing just one side to do a solicitation campaign. And so when there are issues that involve thoughtful choice, it makes more sense to go to the shareholders directly. And sometimes that also is the pressure that can get a resolution.
One thing I'll just say is that in this Ritchie Brothers campaign, I think this is the first time I've ever seen in Canada a proxy statement being filed in respect of an M&A transaction. I mean, obviously in a contested board issue, of course there's a dissident proxy circular, but I think this is, if not the first I've seen in my time doing this.
Is that part because Ritchie's dual listing in the U.S. and Canada?
Well, yeah, I mean, the proxy statement itself is a U.S. thing, but just the notion of formally soliciting proxies in this manner is pretty unusual because, you know, we have other means to do it. You can do it by public broadcast, you can do it by quiet solicitation. So this is quite unusual in this context because often what you do as a shareholder is you put out a news release that says, this is why I'm voting against this, come with me, versus a full-out proxy solicitation.
Yeah, in terms of I'm not saying this because lawyers draft the proxy statements and revise them and interface with the SEC on them, and we make fees off the proxy statement. I'm saying it because I mean it. If you're opposing a deal, or if you want to get a deal done, and you're serious about that outcome, you have to be prepared to go all the way, and sometimes that means filing a proxy statement, hiring a proxy solicitor, hiring a PR firm and a law firm, and putting the team together to show that you will take it all the way if you have to, even if you don't end up soliciting votes. The interesting thing about an M&A deal is if you're an investor and you file a proxy statement and you have your own proxy card, well, you can collect votes against on your proxy card, or you could just tell people to vote against on the company's proxy card, or you could just say, stay home.
Well, and that works for most jurisdictions in the U.S., but there are some jurisdictions that the quorum is lower.
Yeah.
The required threshold to get votes is different, so it really does make sense to collect your cards and turn them in. And in other jurisdictions, you want to make sure that, yes, no vote is the same as a vote against.
Isn't the quorum in Canada 25%?
It depends on the company, but it often can be 25%, but not always. I mean, sometimes it's 10%.
It's higher than the UK.
Yeah,
UK is like
yeah.
2 shares.
Yeah.
But yeah, if you so the point is if you mean business, you got to be prepared to take it all the way, and that'll also send a message in future campaigns, whether you're a company or you're an investor, you'll be taken more seriously because you show that you have the grit to go all the way if necessary.
Maybe a question just because I can't remember right now. On the Zendesk Momentive, was there a formal solicitation against, or was it just public opposition? Does anyone remember?
Well, on
There was definitely public opposition.
Yeah, there was a lot of public opposition. On Zendesk, we ended up working with the private equity firms that ultimately acquired Zendesk in that campaign. I don't believe there was an actual proxy fight filed against the private equity acquisition as opposed to the initial campaigns that were much more public.
Yeah, the initial Zendesk Momentive, I just bring it up because that was the last one, at least in recent memory, where we had opposition on both sides. The buyer vote, there was a buyer vote involved as well. And the opposition on the Zendesk side was by Jana, and I think upon the deal getting voted down, they did a bit of a victory lap, claiming it to have received the lowest support threshold for any deal in the last 20 years, if not ever, I think was the wording in the press release, and that was somewhere around 5% if you take out the inside vote. So that is extremely low. Maybe kind of speaks to this general notion of, when there's opposition from multiple parties on multiple sides, perhaps something just isn't quite right there. But we'll obviously see how Ritchie Brothers and IAA play out. I think we might have covered all the angles on that one. Well, actually, we left a big part of it undone with the Starboard piece. But I don't know if anybody wants to talk about that and the kind of the influence that the activists can potentially have by giving their stamp of approval on a transaction.
I'll start. I mean, in that, I've broken the microphone. That might be for everyone's benefit. Look, number one, Starboard got a wonderful deal. They got a piece of paper that I think any investor would want. It has a wonderful coupon on it. They get board representation, and if the deal goes through, that's fantastic for them, because now they get all the upside of the combined company. I think Starboard also was very opportunistic here. It appears that the company only dealt with Starboard, and Starboard, came into the situation pretty quickly. But Starboard basically said, our brand is for hire here. We will come in, we'll get a preferred security instrument. We will therefore be different from every other shareholder, but we're going to use our brand of working for shareholders to tell the whole world this is a great deal for shareholders. Yet, we get preferred economics vis-a-vis those very same shareholders. So for Starboard, it's a wonderful deal, and the renting of the Starboard brand for the purposes of this deal, I think it's a great tactic, and I think we're going to see more of that in these deals going forward. It's not the first time Starboard has done a PIPE during a shareholder activism campaign, but I think it's one of the first times you've seen an activist do this in the middle of an M&A deal to get an M&A deal done. It's interesting technology from an activism perspective. I think that if the deal does not go through, I'm not sure how often this technique will be used. Starboard will probably be a little bit more careful with what they say about M&A deals they're not directly involved in the future.
Yeah, it happened to them on the activist side at Box, right? I mean, a little bit, there are differences there, but so maybe they learned something. They're good at learning things.
How do you guys think overall market conditions change the shape of contested M&A? I guess I'm kind of thinking about take privates of maybe high-flying tech companies or companies that have generally garnered higher valuation multiples that get taken out for cash in an environment like 2022 or late 2021, where there's a lot of uncertainty, volatility, economic downturn looming potentially, oppositions to deals maybe don't resonate as well because people are happy to take the certainty versus when everything's maybe burning a little hotter and comps are trading higher. Would you expect a willingness amongst the shareholder base to hold out for a higher offer or to be more patient for the development of a standalone plan? That's one example, but just generally, you could take it in any direction in terms of the economic and overall market conditions kind of dictating the types that we see.
Well, many boards now are sort of starting to talk about the potential of shopping the companies and taking private, in large part because a lot of them are viewing a ticking time bomb of refinancing coming up with, we heard at a panel earlier today saying how great the IPO market is, and the financing market is, but we haven't seen it yet. And so boards are, at least the ones that we're advising, are starting to panic a little bit. The result of that, and as we're seeing, is that some deals are getting done at prices that many long-term shareholders aren't finding to be optimal in today's day and age, and a lot of them, to your point, would much rather sort of ride it out or at least find another way to get value, which is why, like I said, for the first time, I'm really seeing every deal that gets announced, there being significant opposition. So I do believe there is a bit of a disconnect between what long-term shareholders view as the value of their investments and what boards are doing to try to avoid hitting the panic button.
Yeah, I would agree with that. I saw it all the time at ISS. I remember the Roche Genentech deal. There was one fund in particular that just was a uber bull, on the target, and his model was just so far, different and higher, obviously, than anyone's on the street, that you couldn't get him off of that. And I think, with volatile markets, what we see a lot is the anchor, they call it anchoring, psychologically. Shareholders anchor their expectations of value at 52-week highs, at all-time highs, or where they bought it. And even if that doesn't make sense anymore and the world's changed and you're getting a 33% premium or whatever the case may be, they're still anchored to that higher price. And I think that creates a lot more opportunities for those shareholders to say, hey, I've written it down, I'm going to ride it back up.
And I agree there. And if think about Uber. Think about the Uber transaction where people were really questioning what the value of Uber was. And if you were an Uber shareholder, of course you wanted that deal at $54 at a price that you'd never, $54.20, sorry, Mark.
Twitter.
Twitter, thank you.
Yeah.
I scared somebody, Uber, Twitter, but
Don't stop buying shares of Uber.
yeah, again, what I say is just personal. So think about Twitter and think about the price there and how shareholders react. And yet, management is put into this position very frequently in especially tech, where they're saying, we're not going to be worth as much as this deal. And so an investor may disagree about what that price is, but ultimately, you've got to get to a point where if management is not saying they can manage up to where the buyer is going to get there, deal's got to get done.
They go on the road and they talk their own company down.
Yeah, I think that's the point I was going to bring up. That's what gets really interesting, where within a quarter's time, post-deal announcement, all of a sudden management is highlighting all the risks and uncertainties to the business, whereas on the previous conference call, they were lauding all their opportunities and everything they could be executing on over the next 12 months. That's where it gets a little cynical. And there was one recently last year, Avalara, where this was a 20% grower SaaS company. Management team looked fine. They said only good things about the business until after they struck a deal to take it private by Vista. There was a number of kind of conflicts and questions in the process. Members of the board that had connections to Vista funds. There was a lot of issues, but the central argument there by not an activist, but by a pre-IPO investor who came out publicly and almost solicited votes definitively, but just launched a public campaign, was essentially that this is getting this company very opportunistically in a time where tech valuations are down and the fundamental value of the business hasn't been realized. So it becomes a question of kind of what I was alluding to earlier of, do you want the cash and the certainty now, or do you have the patience to kind of bear this out, even if tech valuations are going to be maybe... Cut my mic, I'm out. That's enough of me, I guess. Q&A.
That was kind of an abrupt stop there.
No, that's fine. Yeah, no, it's.
Are there any questions?
Yeah, I was going to say I was just about to turn it over to say if we want to do questions.
Keith, you're going to get your chance to talk in the next panel.
You guys touched on it. I have a question for the advisors. Maybe Lawrence, this is really in your alley, but why do companies that are being acquired make the press release and don't host a call for shareholders?
That's a very good question. They're probably not talking to any one of the advisors on this panel. I think it's a very good idea for a public company and the acquirer, particularly if it's another public company, to host a call together about the value proposition. Look, you can make the argument that if the tool of shareholder if you have 8 different means of communicating with shareholders about a deal, and you choose to use 4 of them, maybe there's something about the deal that's you're not ready to describe, or you don't want to describe, because you'd like the deal to just kind of float by. That could be a reason. Another reason, that was the cynical reason. Another reason could just be it came together really quickly. Maybe, and I mean, I've seen this sometimes, maybe you see this as well, but sometimes you get close to the end of a deal, to signing, and you're concerned about leaks, and you have to get out to the market really quickly. You just do the best job that you can to get out to the market. I think in those situations, having a follow-up communication could be helpful to fill any of those gaps.
All right, one more.
What do you think is going to be the outcome of the Salesforce situation?
Salesforce?
Art?
I'm out on that one.
It looks to me like there were a number of activists in that stock for a long time, and the company was, I know, interviewing advisors about 2 months before Starboard showed up, and probably 6 months before Elliott showed up. I think the company was long planning cost cuts and changes in the board composition. It's not easy, and it doesn't happen quickly to get a firm like Value Act to come in and help you refresh a board in the face of multiple activists in the stock. So what I think is going to happen there is I still think there'll be some negotiated resolution because there are so many activists circling the stock, but I don't think there's going to be a sea change of further shuffling of board members, maybe 1 or 2. It's an interesting scenario. Now, what would really make it interesting is if Third Point, Starboard, and Elliott each ran their own proxy fights, and we had a ballot with like 22 candidates on it, and they all cannibalized each other. I think that would be fascinating. I just doubt that's going to happen. Bruce may know something different, or Andy Friedman, I saw him sitting in here. He probably knows exactly what's going to happen.
That's more of a stay tuned, but it's a great panel to talk about universal proxy cards, but I guess that's not our panel.
Yeah. It's coming up. It's coming up soon. Okay, guys. Thanks so much. That was really terrific. Everyone, give him a hand here.